Ladies and gentlemen watching, I want to introduce you to James McCarthy. I'm going to rip this straight from his website, Jameson Capital. To describe him a little bit, he has 50 years of experience in finance and private equity, successfully closing billions of dollars in transactions. He's been an investor, lender, investment manager, portfolio manager, financial advisor, corporate consultant, workout consultant, and city planner. Clients have included domestic and offshore institutional investors, investment funds, hedge funds, high net worth individuals, and private companies. He holds an MBA from Columbia and a master's of city and regional planning from Rutgers. You're also currently the COO of BDIC, Blockchain Deposit Insurance Company's RWA Consulting Corporation, which is what we're going to be talking about today. Before I go forward, James, is there anything that you would like to bring up as we get started in this interview today?
No, it sounds like a really interesting guy to speak to. Sounds so much better on paper.
That's why we spend all our time refining our bios, because it sounds much better than the real person.
Yes.
No, but this is exciting. I remember when I first started helping Jeff out with BDIC way back at the beginning. Very shortly after I put him through the due diligence ringer, I did everything short of calling up the different registration offices in Hong Kong, Australia. But
Right.
very shortly after that, probably a month or two after that, you came on as part of this RWA arm. And
Right.
it was very interesting. I remember reading through your whole bio. I kind of skimmed through the Jameson Capital website. And you're quite the expert in this space. And so I'm excited. We're going to be talking about tokenization specifically. And I think the listeners here and the people who watch it later are going to get some real wisdom from you specifically. And it's not just flattery, I promise. So,
Hope I can perform.
yeah, no pressure, right?
No pressure.
Um, I do this in every interview that I have first time with somebody. From my journalism classes in the past. Let's start off with, let's talk about what BDIC RWA Corporation does and why people should care.
Okay. It's actually a spin-off from BDIC. As you explained in previous shows, BDIC provides insurance for certain crypto assets. So that ties into tokenization, in that cryptos are on blockchains, plus people use crypto assets to make investments. Tokenization is putting investments onto the blockchain, and you can invest with crypto or not with crypto. The driving connection is the blockchain existing.
Mm-hmm.
So as BDIC went to companies and said, we would like to insure your tokens, people said, oh, yeah, that sounds great. I love the idea of tokens. Everybody says I should do it. What is it? How do I do it? So BDIC kind of said, okay, how about we'll set up a division. I mean, I'd already joined the board to review assets that were going to be insured, because as part of BDIC's due diligence, we want to make sure we're not insuring some scam tokenization. Right. So then we said, why don't we just set up a division to actually help people do tokenizations? And so that's what BDIC RWA Consulting is. We are going in everything from real estate to land registries to other assets and helping people tokenize.
Perfect. I actually wanted to pause on that right there because this has been a recurring theme on the shows I do with Brandon Byrne, including the one that we did not too long ago. We did this maybe 2 or 3 weeks ago. The comment about we want to make sure what we're investing in is not a scam. I would say that what people didn't expect on the bingo card, maybe that phrase ages me, for 2025 was the number of opaque and kind of incomprehensible private arrangements that a lot of investments were being thrown into. For people who don't know, a lot of the lending side of the AI build out that's been happening has been done through private credit specifically through SPVs, special purpose vehicles created by the banks. And many of the credit defaults we just experienced in the last 2 or 3 months were, in my opinion, because of a failure of due diligence. I understand that some of that's a little bit more difficult to do at scale, but I think it's really important to point out there that BDIC, one of the first things they did was bring you on and say, okay, let's make sure what we're investing in is not a fraud.
Right.
That is going to bring a lot of credibility to the company, in my opinion.
Yeah. But we do not provide opinions, so it's not like we're saying we investigate these things and if it turns out that something's wrong, come sue us, to be blunt. But we want to be careful of what we're doing.
Right, for sure.
Yeah.
Well,
And
because go ahead. Sorry,
I was
for
going to
sure.
say, right, with the private credit thing, there's too much money chasing deals. So it became a question of let's not do as much due diligence as we should. Let's make the loans covenant light and we'll be competitive. We'll get the deals, we'll get the fees, and somebody else will get the headaches.
Sounds about right. Which is 100% right. When I was writing about this not too long ago, by the way, Eric's Corner, I saw you join the live. Thank you for joining us. Hope you stick around for the rest of the show. It's going to be a lot of insightful information. It's a lot of fun. One of the things I realized as I was reading through, specifically, it was an article by the Atlanta Fed. It's a couple years old, but I think it describes the situation very well. Is like you said, these covenants were light. They were like, oh, there's high competition in lending to these companies and lending to these real estate funds. And we don't really have the time to do the due diligence. They might go to somebody else. On top of that, these contracts were very bespoke, according to the Fed. They were very, very complicated. So there isn't really an exit for some of these contracts at these banks, like Zions Bank here in Utah is one of the ones that got hit hard. There wasn't an exit for them. They couldn't go resell them because they were just too complicated. And because of all that, you have a situation where people could get away with saying, well, we'll just write the loan for this and someone else will have to deal with it.
Yeah. Well, there's actually something on that which is important to tokenization. PE funds have a lot of questionable assets. They bought companies at high values, stripped them, put on a lot of tax deductible debt, promised that they'd be selling them out at a profit, and now they're sitting and they can't sell them. So there's a whole market developing of PE firms selling assets to other PE firms. So kick the can for it. I paid $100 for it. I'll sell to you for 105, then sell to Joe for 110, and then Joe will sell back to me for 115. And the deal never goes bad because it's just sold onward and everybody collects fees along the way. So that is going to be a target for tokenization of people trying to do that, which makes the due diligence issue even more important because the old computer slogan of GIGO, garbage in, garbage out. Just because you're tokenizing it and make it more efficient doesn't mean it's still a good investment. It's just a bad investment that can move faster.
Yeah. It's a bad balance sheet that moves quicker and in smaller pieces.
Yeah. Mm-hmm.
I think that's important to realize as well for people who don't know what we're talking about, because there are some people who watch this show who don't come from a finance background like we do. Private equity has a bad habit and has had a bad habit for the last couple of decades of purchasing companies, ratcheting them up with leverage, and then trying to sell them off. What changed I don't know when exactly it happened. I think it was about 3 or 4 years ago, at least from all the sources that I listened to. They stopped being able to sell them. The valuations got too high, it got too expensive. So now they have assets that are losing value on their balance sheets that they are trying to get rid of.
Right.
This has gotten to a big enough problem where it's affecting the big names, Apollo, BlackRock. I was listening to Steve Eisman talk to an analyst around private equity, and that was one of the things he brought up is moving forward into 2026. Not financial advice, also not my opinion, it's his, but the private equity companies as is are not going to do well because their assets are struggling. Because they bought a bunch of companies that they're not going to be able to move on to they're not going to sell to the next sucker. No one's wanting to buy. Um, I do think tokenization, that's kind of the double-edged sword of that too, is
Yeah.
tokenization, that industry's ripe for tokenization because it makes exit liquidity easy. People get access to the private market, which is something that a lot of retail investors have a hard time getting into with low capital. But it also means that you're going to get cockroaches, just like Jamie
Yeah.
Dimon says about the private credit.
Well, that's because the benefit of tokenization is also the vulnerability in that the when you tokenize, you're opening it up to a global market because the tokens can be sold anywhere, and markets are starting to develop interchangeable, so you can list on one and list on a dozen around the world, which means that people all around the world get to look at assets, but they can't tie it because you're sitting somewhere in Thailand and you're being offered a real estate project in Indiana. What do you know? Plus, it's smaller amounts, so it's opening. Well, the big boast for private equity is it's opening up investment opportunities to smaller retail investors who normally would not be able to have access to these investments. And similar thing with real estate. Nobody, if you've got $100,000 to invest, you're not going to have the opportunity to buy into a Class A project somewhere. So tokenization opens that up to the world and to the retail market, and it's to investors who are going to have limited knowledge. They're going to read a prospectus on a website, and a lot of them are going to get burnt.
Yeah. And that's the
Yeah,
unfortunate reality, I think.
yeah. It's going to be a problem for the industry because we're going to be starting up this coming year. It's where the boom will start occurring. And then there'll be a couple big scandals, some of them with a certain T name on them. And that's going to put a black eye on the industry. And then we'll have to recover from it.
Right. I wasn't going to go this direction already, but because we're talking about this, let's actually jump into it. So, for people who are watching at home, this is not a new industry. This has been happening for a while. Companies like Realty have been doing this with real estate for several years now. And there's a body of research growing in academic literature to support this. Two that I wanted to talk about. First off, there's a great paper that I think came out of the University of Chicago. I'd have to go back and check. But the idea was they created a framework for how frontline regional powers, they call them hromadas in the Ukraine, could use tokenization to rebuild after the war because it allows them to do things like create tax futures based on a project or take the rent from a future building and turn that into tokenization, sell it on the open market and get the funding to create the building in the first place. This happens successfully already, so it's not just these large scale projects aren't just theoretical either. Aspen Ridge Management created a ski resort in Canada called St. Regis Resort that used what's called a securitized token offering. They tokenized future rent and sold them as basically shares of that rent on the open market using tokenization. And it worked really well. From the paper that I was reading, they got a higher level of funds than their original NAV with standard real estate investing, net asset value. Um, but then they struggled to sell it to new investors later because it was still early and the tokens were kind of complicated. Um, so we're going to jump into this right away because you're already hinting at it. But if we're looking forward like 3 or 4 years down the line, what does this market look like as it starts to kind of get its feet under itself and starts to actually get going?
Market looks huge because there is a inherent value to tokenization, which is just an operational. To tell people, when you look at tokenization, it's just a new way of doing the same things we've done. So you build the building, you sell the building. Today, you sell it to an institution or you syndicate it to a bunch of wealthy investors, or you give it to Raymond James and they run around and sell to retailers. Tokenization does the same thing, but in a much easier manner. And it's a more global manner, and you can go small. If you're trying to do a $10 million raise, you could go to one investor for 10 million, or today you go to most funds and they're like, I don't want to write a check for less than 50 million, 60 million. So there's big money available. But with tokenization, you could do $1,000 an investment because the software manages it. It's not like, if you 5 years ago, if you did a syndication, you have to do the K1s, you have to do 1099s, you have to do all the paperwork that's required. And if you have 10,000 investors, that's a lot of accountants sitting around at the end of the year drawing up,
Yeah.
K1s. If you have a tokenization system, it's like, let's say it's a loan, so it's interest, so it's a 1099, the system can create the 1099 and send it to the investor. So you don't care if you have one investor, if you've got 10,000 investors, the computer spits it all out. So you get a wider, more efficient function. But you're doing the same thing behind the scenes. I built a building, I, I,
Right.
and I sell the equity in it. Whether I sell it to one institution or I send it to 10,000 tokens, I'm doing the same thing.
Hmm.
The market's going to look at it. Well, show my age. There was a time in which you bought a bond, and each quarter you go into your little bond book and you tear out the little coupon and send it into the broker for them to pay you. And then it moved onwards to where it was done electronically, and now you could do it on your phone. Tokenization is taking things like real estate and private equity and pretty much anything else and taking it from the tear the little coupon out of the book and mail it in to get paid to you can do it on your phone. There's a reason to do that for anything. It's just more efficient. It's more effective. And with using blockchain, you can track everything. It's totally auditable. It makes it a little harder for people to embezzle because you can go back into the blockchain and check it. And when you have things like BDIC, you don't have to worry about your cryptocurrency being stolen. In tokens, a little different because, like as we do it on the consulting side, you can set up your token on one software that you can't change the token or destroy it. Or you can set it up on the software where if somebody steals your tokens, you calls up the manager and the manager it's called burning, destroys the stolen tokens and gives you new ones. So there's a lot of little intricacies involved in it. But it's just so much better way of managing things. And so it opens it up globally and it opens this up to small investors, which is the flip side of the problem, where you
Right.
said Aspen St. Regis. They did probably the first major tokenization. It was actually done for tax reasons by its parent company, Overstock, the company that did the tokenization. But it was a tokenization, and they sold out, and then they sat there. There was no market, no distribution. I
Right.
got involved in tokenization about 5 years ago. In 2023, we actually put together a fund that was tokenizing. We got all the way down. We had our Reg D done, everything all put together, and we looked at it and said, why? There's no market, there's no distribution. We could create the tokens and they'd sit there in somebody's computer somewhere. So we just never pulled the trigger.
Right. Right.
Today, stable coins exist. And, the Genes Act created them, and suddenly now everybody's into tokenization. They secretly were. And it's like, I love Jamie Dimon was always like, oh, tokenization's never happened. Oh, it's blockchain bullshit. Oh, it's all crap. And then, of course, as soon as the stable coins came through, it was like, oh, yeah, Chase, they've got their Onyx blockchain system that they've been working on for years now and all this
Yes.
stuff. And it's like, they knew it was coming. They were preparing behind the scenes so that when the day came, they could launch. And
Right.
Genius Act gave them the launch. And now they're going to. So the other day, there are 123 stable coins already. And they'll easily get over 200 in the next couple of months. But now the banks are coming into it. But everyone loves it. Everyone wants it. Everyone's token. There are no other tokens, which is why we're pushing on the real estate side because we think that's the huge market, the world's largest asset class.
Hmm.
And shortly, there's going to be all these machines set up to put out stable coins. with no product. So we think all the people who are tokenizing stablecoins now are suddenly going to say, now what do we do? I've got all these
Yeah.
people working after all this money sunk into data centers, and there's no more stable coins because everyone's now using bank deposit coins, which are cream stable coins.
Right.
And I need assets, and it'll be real estate and it'll be private equity.
Right. I want to hop to this question Eric asked us on the live. I'd like to share it because we want people to ask questions on this show. We've started to get some commentary and we love it. So we want people to watch it to ask our questions. I'm going to try to do my best to answer this, and I'm going to turn it over to you, James. And Eric's question is, could this be used for small business investment, for startup funding, for example? In my mind, hypothetically, I see a world where VCs and accelerators could do this. I don't know if it's going to happen right away. The markets that I see, like an SBA token, is his response. And the answer is hypothetically yes. Right now, from what I understand and what I've observed, the tokenization market right now is going for the big fish. They're going for the large private equity funds, the large real estate projects, infrastructure financing, things that have a high illiquidity premium that tokenization companies and managers can take as they tokenize these and sell them on the open market. Further down the line, I could see someone like Andreessen Horowitz, Kickstart, another one of the big funds here in the United States, doing the same thing. I think it might be a while. The SBA or the SPA administration, I'm not sure. I haven't lived very long. I've only lived like 28 years on this earth, but from my observations already, it seems like the federal government moves fairly slow when it comes to this kind of technology. So it may be a while before SBA loans are tokenized. There's a potential future where that happens as well, though, because again, it's just more efficient. Now I'm going to pass it over to James to totally destroy my answer and give us the actual answer.
Not quite destroyed, but you have to divide it into different, I guess, silos is the current buzzword. You've got blockchain, which is just like a gigantic Excel spreadsheet. So you can use it for anything and use it for back office operations. So a small bank lender, anybody like that can use that as a fancy Excel spreadsheet. Then you've got tokens as utility tokens, which are things like memberships. You could have a membership club, and instead of having a membership card, you have a token, and that token you could put on a market and make it available to somebody else if you want to sell it. Where it's not being used as an investment, it's just a way of managing something. Then you have the security tokens, which are the investments, and then you have AI. There are a number of companies active that are using AI to underwrite loans. I saw one the other day with a home equity loan. You plug in your address, your current debt, and it pops up with saying how much they'll lend you as a home equity loan, and then they process it right on site. Well, that's all nice and good, but it has nothing to do with tokens or blockchain, except that behind the scenes, they're putting it onto the blockchain for their record keeping so that someday they can package them up, tokenize them, and securitize them. It's not today. That part of it's not today, but it's not that far off.
Right.
I think by the end of next year, all those things will be happening at some level.
Right.
Okay. Except for the government. Yes, you're right. The government will be slower on, which isn't bad because you don't want the government jumping in and spending $1 billion on something and saying, "Oops, we did something wrong."
Yeah.
They should be a little third or fourth player, not the cutting edge.
Right.
I
Exactly.
worked for government once upon a time, and it's like, no, it's not that they're bad. It's just when you have things that are, people's lives are at stake. If the SBA screws up and finds out their computer system and tokenization, whatever they use, it doesn't work correctly, a lot of people's businesses would be affecting their wonder. So you got to be careful there.
Right.
It's not like, if the millionaire loses some money, hey, he made a stupid mistake and he lost the money. A little person trying to start up a business, then they get screwed up because the SBA got screwed up. That's more major.
Yeah.
That's my defensive governance statement. So,
All right. Um, just one more comment on for Eric's question here. I think the other thing that we need to remember here is I'm in the startup world. I've been in it for 2 or 3 years now, pretty much full time. Startups are volatile and it's hard to get the equity out of them
yeah,
for a while. Um, Basically, with most startups, you have two ways out. You can, and there's some other ways, like you can sell your equity to another investor if you so choose. But really, the only two ways you get out of that is you get bought out by a larger company, or you take it public at some point, or you never do and you just have this equity that accrues in value as you make more cash. Because of that, it's difficult for me to see an immediate world where someone like a Realty or another RWA token developer goes in and says, okay, well, right now the equity is worth this, so this is what we'll sell the tokens at, and then there'll be this many tokens, because that valuation always changes as you get more funding as well. Um, and it obviously depends on where you're getting your funding from. SBA seems like it's a slower process, but I know in my world, in the VC side and the software side, as more investors put money in, the valuation goes up, but the shares get diluted. So all of a sudden they're worth a little bit less. So that makes it a little bit complicated. And I could see that being a problem. If, say, someone like, out here in Utah, one of these new AI companies gets a bunch of VC funding, the VCs turn into a token and sell it, how does that behave in the market?
right.
Is that like a loan tranche where it's, this amount is fixed, we're not changing it? Does it dynamically update as new funding and valuation comes in? So that gets to be a bigger
Right.
fish to
But see,
fry, I think.
that's not the tokenization issue. You can tokenize anything. Any security can be tokenized, but
Mhm.
there's what should be and what can be.
Right.
VC could sit there and say, all right, I've got this startup company. I value it at 10 million. I'm going to tokenize it and put 5 million of the tokens on a market so they could trade. And then people will have to trade them and decide what they're worth. But how do you decide what that's worth if you're not a VC who understands startup? But on the other hand, why not? If there are people who think, you start a tech company, and there are people who are in the tech industry who can look at the company and they want to say, I'll put 10,000. You go to VCs, you say, I want 10 million. But some person in the same industry may look at it and say, that's a great idea. I'd like to put 10,000. So, and you see things like that on some of the smaller crowdfunding sites where they're raising $1 million, $2 million.
Mhm.
So I would say you can't do it. It's a question of how do you present and the due diligence, because
Right.
startup is difficult on the valuations and due diligence, and you take a chance that a disgruntled investor will say you didn't reveal something. You've now got a public security, which means that you can get sued. That's sorry, off to the side. You can get sued for something, so there's that consideration. But you can do it if you want to. I'm just not sure it's something you really do. But you did mention the how to bring equity out. One of the advantages of tokenization, one of the things we on the real estate side, to my industry, you have the problem that people build, they're called merchant builders. They build a building, they lease it up, and they have to sell it. And they have to do that because their partners want to get out. Alternatively, you can structure tokenization. You get a limited partner who wants to get out, they can sell their tokens. They don't have to go to one of these specialty firms and take a 30% haircut to sell it.
Right.
Or you have institutional partners. Maybe somebody wants to sell, maybe somebody wants to stay for 10 years. Because it's tokenized, you have the ability to sell sections of the property without having to go through the entire process of selling the property, forming new entities, and so on.
Mhm.
So it's as you mentioned, liquidity. It's a tremendous boost to liquidity because
For
you can
sure.
break the equity and debt and everything down into pieces and
For sure.
publicly offer those.
Right.
But remember also, coins. as BDIC is about to launch its initial coin offering. That's effectively a VC rate.
Right.
Company, offer invest a certain amount of money with us by buying a coin. The coin will be used for this purpose and will go up in value as the company develops. That's a VC investment.
Right. Right.
So sorry to disagree.
It's okay. This is one of those worlds, and this is why I was so excited to talk to you, because this is Jeffrey just came on and said the CEO likes shameless plugs, which I appreciate. We're about to do a whole lot of plugging, Jeff, so don't you worry. Um,
Even some for BDIC.
um, RWA is a new industry to me. You've been doing this for 5 years, but this is something that I'm fairly new at. I'm doing a research fellowship right now. It's the topic of my research fellowship. Um, and don't get me wrong, for Eric, who's asking, this is going to change the world of funding, I think, forever
Yeah,
because of this issue where you don't have money that's locked up for 5 or 10 years anymore. It can be turned around and resold immediately. Now that also comes with, I think I was talking with, I can't remember if it was Alex Hickey or who, but I was talking with someone recently. It comes with the same kind of sword of Damocles here that crypto has, where it's a lot more punishing if you get it wrong because it moves faster.
yeah.
This is one of those things where I'm previous to this last conversation I had with someone, I was talking with my brother and dad about this. Everyone was confused for a while, like, why did the crypto market crash over the past 2 months? What's going on? In the background, I was seeing things like excess leverage. And one new thing that I learned about, which is important here, is a lot of smart contracts don't have circuit breaking clauses. It's not like a trading
Right.
computer where the person who owns the computer, the fund that's doing the high frequency trading, can say, okay, if the volume spikes by this much, you need to stop because we're going to blow this company up.
Right.
A lot of the smart contracts, they don't have those. And so people make dumb decisions and you'll get punished for it quickly if you get a downturn. So
That's
that's
part of where it's the nuances, because you can put that into a smart contract. It's just a lot of people didn't think to put it into a smart contract. So that's part of what we're trying to do with BDIC Consulting, of pointing out things like that,
mm,
uh, or the maximum purchase. You may not want someone to own more than 10% of your offering. You
right,
can limit that if you use the correct platform. You can't if you just use one of these, generic white box type things. So
right,
yeah, there's a lot, but you're taking a lot of private assets and making them publicly tradable assets. So the timeline, as you said, turns from, like, we've discussed PE. PE will kick the can forward, kick the can forward, kick the can forward, as long as it's just within the club. Put it
right,
on a public market, and get up in the morning and check the market, and the PE fund's assets could have been marked down by the market by 50%. And it's
right.
known because it's a public market. You don't
Yeah.
know that if somebody says, "Oh God, this thing's worth 50 cents on the dollar. Don't tell anyone." You can do that if
Right.
it's a private market. You
Yeah,
can't do it if it's
exactly.
publicly traded.
Exactly.
So yeah, total change in that'll be a shock. It'll be a shock to a lot of these people who are used to. But it's like I once asked a gentleman who was running a fund why he was making a certain investment, and I said, I don't see how it's worth it. And he goes, well, maybe you're right, maybe he's wrong, but it's a 10-year fund, and I retire in 7 years. So can't do that if it's a publicly traded asset.
You know, it's funny, James. As you were saying that, I was reminded of Apollo CEOs, or maybe it was their president's comments about the private credit market, where they're like, the private credit market is fine and there's nothing wrong here. We're not having like mass weaknesses across the system, which some analysts have criticized them for this behavior of, we'll just throw some stuff in a box and sell it to the next person.
Right.
Um, and then shortly after he said it, the Carriox Capital scandal happened, where none of the receivables were real. None of this all the documentation around, we're going to have this much revenue coming in. It was all fake. It was one massive scam. And I just imagine him sweating in his office. Because you're right, this is what's going to happen as that illiquidity premium disappears, is people are going to demand a higher level of transparency from these private companies. They're going to want to know what the company's worth. They're going to want to see the balance sheets here. And actually, that was going to be my next question. We're getting close to the end here, but before we transfer over and talk about the BDIC news that has just come up, with the tokenization market, how do you see this affecting specifically kind of the information asymmetry that's happening right now in private markets? How do you see like reporting requirements changing?
The reporting requirement, well, because these are securities. So if at least in the U.S., if you're going to do it, it's going to be a Reg A, Reg A plus, Reg B, and you're going to have all the public reporting requirements, which is a big difference because, again, you're going from the private world where the reporting requirements may be you call your cousins up and say, hey, this is how the deal is doing, to you have to actually file formal audited statements. So there'll be a lot more reporting, which doesn't necessarily mean more transparency. It doesn't actually mean more truth because, as you just said, all those reports, the audited statements, the sales reports, and so were all false. And you see that all the time. There was the large money transfer company out of Germany that was reporting transferring trillions of dollars out of a office in the Philippines over a little grocery store, and nobody caught it. Or, of course, Madoff, where he simply moved the money from London to the UK, New York. If the New York auditors came in, they said, well, all the money's in London. And if the London auditors came in, they said, all the money's in New York. And nobody thought to call the other side and say, hey, Joe, is the money there on your side of the pond? So, JB Diamond, Chase just had a suit where they bought a company that's all falsified. HP had the big thing where they bought the company in Germany. So the reporting is still going to be the same, and people are going to lie. It's going to be the same thing. The due diligence will be, oh my God, why didn't somebody check that? But it will be faster because it's a public market. When the bad news comes out, it will hit immediately because you can't withhold the bad news because then you get sued by the SEC for not telling people, and people see what's happening, and it happens immediately. It's not going to be, let's work on it. We'll see. We'll try to work something out. Give me a call next year. We wanted to come in after the end of your statement. You're not going to be able to do that. So big change there.
I think that will be good for the world, frankly. If I had to, I do want to leave you a couple minutes here at the end to kind of give some closing thoughts, but I think that alone, the headsman's axe that is the discounting feature of the markets, I think is going to make a lot of private markets a lot more honest is the wrong word because it's not, but it's going to be faster and people are going to get a better handle on what they're actually buying, which I think is going to be good. Let's take these last 5 minutes because we wanted to talk about a big piece of news that came to both you and I the other day from BDIC Insurance. For people who don't know, here's that shameless plug for you, Jeff. BDIC Insurance is offering wallet and deposit insurance for crypto. I have been saying for years that this is one of the things that has been missing from the crypto industry. Even before I met Jeff, for a year before that, when my buddies would talk to me when we were all sitting around the Bloomberg lab at UVU, they'd ask me, like, where's crypto going? And I was like, honestly, I can't know for sure. I feel like it has a good future, but there was no infrastructure to support it. There wasn't an insurance company. There weren't payment endpoints. And BDIC is taking a huge step in the right direction by offering that. It's going to offer what Jeff and I were talking about when we did our live together. It's going to offer that sleep factor, which is the best return you can get on an investment. The big news that just came out is that right now the company is ramping up for their first token offering. It's going to be coming very, very soon. And trust me, as soon as it's public, I'm not sure how much information we can share at the moment, but as soon as it's public information, people will be hearing about it here on Wealth and Wisdom. They will know about it. I'll share the link and everything. As someone who's done this over and over again, Jeff, how is this going to play out? What's this going to look like as we approach the next days, weeks, and hours down to the sale?
It's missing its chance.
Care to elaborate that on a little bit more?
Well, a coin offering is a way to participate in the company's growth. It's not equity in the company, but it's a participation in its growth. The BDIC is launching its insurance policy, as you said. It's not unique. I think there are 2 or 3 others, but again, like everything else, you got to look at the fine print. BDIC actually offers insurance where you easily get repaid, as opposed to some of the others where you have to go through a big hassle and maybe you get paid. And I can't knock the competition, our competition, too much, because that's bad, but I can say they're really good, backed by big real insurance companies. It's a real insurance policy, not somebody say, hey, wow, this is a cool thing to do. There's a lot of what is happening in this industry at the moment. Good idea. Set up a website and you're in business. This is real insurance, or backed by real insurance companies, and it's needed. And we read every day of people losing their crypto. So BDIC insurance covers everything except if you lose your wallet key, that's that's not covered. It's not theft. On the other hand, I believe there is a relationship with a company that will cover that as well. But we'll refer over to them. But BDIC is you go in your wallet one day and find out that somebody hacked in, or the company where you had your crypto stored is now in BK, or you just read how the German federal police have arrived at their headquarters, and you can contact them if you want to get your money. So BDIC covers all that stuff. And it's obviously a play off of FDIC from the U.S., and it's a component that makes it real. You look at it from a younger point of view, a young person, they're used to the phone, they're used to these things. You look at it from an older person's point of view, it's like, how do I know my money is safe? It's not in a bank. It's not in a government insured institution. It's in some company that's something or other .io. And what the heck is IO? I've heard of .com, but what's the .io? So this is you're now covered by a real insurance policy. So as I said, it gives you the comfort level to hold crypto. If you're holding crypto, it'll give you the comfort level to use it to buy things, invest in things, and it'll make the industry grow a lot faster, a lot safer, and then more tokens for me.
Well said. Perfect. Well, James, thank you so much for taking the time to meet with me on a Saturday. It's been kind of a game of phone tag for us to get this set up, but I'm really grateful that it's happened. What are your closing thoughts? What would you like to leave the audience of Wealth and Wisdom with as we close this out?
Well, you look at tokenization, look past the verbiage, and it's really just an investment. A token represents a security, an asset, an LP interest. It's the same thing you're doing now, but it can be good to a global basis, smaller investors, and do your due diligence. Do not just log onto a website and say, gee, that's a pretty picture. It looks good, which a lot of people have done in the past. And I've sat in chat rooms where people have said, oh, that looks like a good house. Oh, no, there's a bar down the block according to Google. That's not due diligence. It's your money. Yeah. You're investing it. It's truly a financial instrument. So be careful. And when the scandals hit, don't be surprised, but don't run. As they say, it's the best time to invest is when the market is down, especially if it's down for a reason that has nothing to do with the fundamentals.
Well said.
Huh?
Ladies and gentlemen, James McCarthy. Thank you so much for taking the time. And we're going to close this out real quick. For people watching, just a little quick piece of housekeeping that came to my mind as we're talking. That really resonated with me, James. So at some point in the near future, I am going to be doing either an article or a live talking about the due diligence process. What do you do? What do you look for? And how do you protect yourself from, especially in the crypto world, scams? But thank you so much, James. We're going to be closing this
Yeah,
out and looking forward to talking to you again in the future, James.
sure. Thanks for having me on, and apologies for being difficult to schedule.
It was both of us. You're totally fine. This is Wealth and Wisdom signing off.